coaching webinar today. So it's been about 7 months since we dove in and did a review of our funding products. I thought now would be a good time to do a refresher, talk about some changes. We've got several new programs that are available now that weren't around 6 months ago that we're going to be diving into, checking out and taking a look at today. We got a bunch of stuff to go over, so we're going to move at a pretty fast pace. And for those of you that hear me talk normally, you're going to hear what a fast-paced me talks like, because we've got, like, again, a bunch of things to go over today that we need to get through. Before we do, I just kind of want to remind everybody that we have started or we have been reporting to CreditSafe. So for those of you that are interested in building your business credit, we had a tough time with Experian, D&B, and Equifax because we're in the business credit building space. But with our relationship with CreditSafe, your payments all get reported to CreditSafe to help you build business credit. It's one of the most up and coming reporting agencies here in the United States, very big in the international community. So just let you know that prepaid enrollments, done for you marketing, anything like that you're getting from us, those are reported as separate trade lines on your CreditSafe Business Credit Report. So I always forget to mention that, and I just wanted to drop that quick note as we get started. All right, so can your customers get business loans? Well, that's exactly what we're going to talk about today. We're actually going to talk about 27 different ways that they can get financing. So for those of you that want the simplest way to know if your customer can get a loan, here it is. It's pretty simple. Whenever you're talking to a customer, there's three main things you need to ask. Truly, there's two main things you need to ask. The third is rare that they have, but sometimes do. And it's basically cash flow and credit are the primary two things that you want to know of anybody you're speaking to. One, do they have good credit? Good credit is not really defined as a FICO score. It's more defined as a credit profile and score. So if you had to narrow it down to a FICO score, it's about a 680 FICO score higher. But what we're really looking at is not credit score. We're looking for somebody that has established credit, that has revolving accounts, that has some depth to their credit, that doesn't have derogatory items on their credit report. No, that's got pretty good credit. If they've got good credit, 680 or higher, no negative stuff like that, they could typically get financing. If they have consistent cash flow, they could get financing. And what we're typically looking for there is good cash flow management. Are they overdrawing their bank account? Do they have more money going in the bank than going out? Do they have $10,000 a month in revenue or higher? If they have those things, those open up a lot of funding options. The third one is collateral. Do they have some kind of collateral? We'll talk about a lot of different kind of collateral lending programs here today. That's very rare, though. A lot of people you're going to speak to don't have 401ks or stocks or equipment or inventory they want to pledge to be able to get financing. So if you ever had to ask somebody two questions, the what is the revenue and what's the credit would be the best two questions to ask to get a pretty good idea of all the financing they can qualify for. Now, what's nice about the 3Cs formula is this. If they have a C, they could typically qualify for financing. If they have two of the 3Cs, like credit and cash flow, they can qualify for more types of financing, like term loans and lines of credit. If they have all 3Cs, that's what opens up SBA loans. So I really like this formula because it's super simple. It's easy to remember. 3Cs, cash flow, credit, collateral. The more of those they have, the more different types of financing become available. If they have none of those, business credit's the catch-all that gets them money. So this is what you're typically looking for to determine if your customer will qualify for financing. So let's dive in and talk about cash flow first. So the most common kind of financing out there today is revenue lending and merchant cash advances. This is super fast money, 3 to 7 days. We've got funding in as little as 24 hours. It's easy money. There's no credit score requirements. There's no collateral requirements. A lot of lenders just require that they send in 3 to 6 months worth of bank statements, possibly merchant statements. We even have lenders now that just get that electronically online and don't even require the bank statements be sent in. The customer, or we plug in the customer's bank account and they get it electronically. Okay, so all that's needed for approval is those statements. Most of them are still paper, where they want them emailed or faxed or uploaded securely. Some we can now do through the artificial intelligence, which we'll talk about a little bit later today. And typically, loan amounts are equal to about 12% of the annual revenue. Now, that's a rough estimate. It's sometimes lower, it's sometimes higher. If we have a lower risk borrower, we can do a first and a second of these, which means we can sometimes get them 2 loans. So it can be well more than 12%. But on average, about 12% of the revenue is what somebody's going to get. So look, mortgages, being a mortgage broker and owning a mortgage company, I could tell you that 9.9 out of 10 people always want to buy more house than they can afford. It's the same thing here. Most people want to get more money than they can actually qualify to get. So this is why what we do is so important, because unlike an on deck of the world that only deals with revenue lending, we deal with all these different kind of financing, and we oftentimes we have to piece together many kinds of financing to get people up to the amounts that they want to get. But so just keep those things in mind when we talk about what kind of percentage that somebody can get. So daily paybacks, this is why people don't like it. They don't like money being deducted daily from their bank account. But lower risk borrowers can get this down to weekly or even monthly before. We try to test a lot of this financing before we roll it out. We've had a few of these revenue deals, and I got to tell you, our rates were pretty low, under 15%. One was as little as 8%, and we had no problems getting weekly payback, which is what we wanted. We even had bi-weekly payback. So again, it's kind of based on risk. The higher risk people pay more. They have to pay back more often, whereas lower risk, you still get the benefit of monthly, weekly paybacks as well. So short terms, typically 6 to 18 months, can go up to 36 months or about 3 years, which is about in line with a term loan. Okay. Usually in the very beginning time that they get in advance, they're pretty low. They're about 3 to 9 months is the term that they get initially. Okay. Then after they prove themselves, the term gets longer, 9 to 18 months. So as they come back and get more and more money, they get longer and longer terms. And what that means is it means somebody could get 50 grand over 9 months. Then when the half of that is paid back, they go to get a second advance, and then they're given 18 months. Well, their payments will stay a lot lower because, again, what they're doing is putting it over a longer period of time. Loan amounts up to $500,000, over 70%. And by the way, we've seen loans right in this range, 400,000 or 500,000 with this program. Over 70% do come back and get more money. So again, this kind of money has a reputation for being extremely expensive, but it's extremely expensive for high-risk people. If you're really high risk, you're going to pay more money on anything that you borrow. But we find that over 70%, almost 7.5 out of 10 people come back and get more and more money using the same program again and again. Rates are all over the board, 10 to 45%. I've seen them even higher. I've seen them 50%, 55% or higher. I've seen them lower. We've secured an 8% rate. We've had other clients we've secured rates for under 10%. So the rates can be wildly high or wildly low. And I think this is interesting. I always think it's interesting when people complain about rates, because look, your rate's reflective of your risk. If you go into this program and you're really good with bank account management, you have some assets and reserves and your credit is good, and if everything is solid, you're going to get low rates in long terms. But if you're not, if your industry is in a high risk, or your credit quality is bad, or your bank isn't managed, a bank account's not managed well, or you have any balances, then you're lucky to even get a loan to begin with, let's be honest. And of course, you're going to pay a higher rate on that. So higher rate individuals are going to pay more on any kind of financing, including this. And again, the fees and interest are 100% tax deductible. So whatever you do pay in interest, you get back. You'd write it off. You get it all back anyways. So what it really comes down to is, can someone afford the payment? I've always been like this. I always. Even I've been in financial services for going on 18 years, and every time somebody asks me the rate, my response is the same, always. Who cares? Look, your rate is directly reflective of your risk. If you want to have a lower rate, be lower risk. And I tell them exactly what their risk is. Your credit sucks. You're going to pay more because your credit sucks. If you care about the rate, fix your credit. Let's fix the underlying issues, but I'm going to get you the best rate I can get you based on your risk factors. I've always talked about people openly and honest about that, because again, so many people ask what rates are, and then they try to determine whether they're good or bad without even having anything to compare it to, when in the end, I promise, you're going to get good rates on almost any kind of financing if you are low risk with that kind of financing. So can't currently be in trouble. No BKs or recent liens. They don't really care as much about credit quality, but they do care about somebody that's on the brink of financial disaster. Okay, you got to have about 120,000 a year in annual revenue, 10 grand a month. We've got lenders that'll go as low as 5 grand a month. But in order for that to work, you've got to have somebody that's lower or somebody that's got compensating factors in other areas like longer time in business or really good bank account management, et cetera. They want you to be in business 12 months. We've got sources that will do this as many as 6 months, even though I have that misprinted. At some point I'll fix that. But they have to, again, have compensating factors for them to work, for this to work and them to qualify. They've got to have more than 6 deposits monthly. They don't want real estate agents to have 3 deposits a month, because if one of those 3 doesn't happen, then they're worried about getting paid back. All these factors only come down to they're worried about getting paid back. No less than 10 non-sufficient funds. You can't be overdrawing your bank account. Again, they care about getting paid back. If they're deducting money from your bank account to get paid back, then they have no confidence if you're overdrawing your bank account every month that there's not even enough money there now to take, because you're overdrawing it, let alone when your loan payments start coming out. Positive ending bank balance at the end of each month. And again, this program could pay you 3 points or more. We split almost all of our funding programs right down the middle with you. So you're making about 3 or 4 points on average with this program. So that's 3 to 4 percentage points when I refer to points. So for example, if you got paid 3 points on a $100,000 deal, that's $3,000. Okay, it's 3%. So 3 to 4% of the deal is typically what you're going to make. We make about double that. We split that again with you. So some lenders now offer credit lines. These lines are usually for about 20 grand and are in addition to the credit, the actual loan. So what happened is these second lines started coming into place. So for example, On Deck would issue a first revenue lending loan. Then another one of these companies that offers, and I can't think off the top of my head who they are, the secondary loan right behind them. Well, these primary lenders started to get annoyed by that. And so what they do is take their lower risk borrowers and they're giving them their own seconds through credit lines. So they're giving them a loan and a credit line, which we've seen is really popular. Now, typically they're going to want to see better credit people and lower risk borrowers to do this for. So often, sometimes they're even going to ask for tax returns. So this isn't typically going to be offered with every customer, but if we have a lower risk customer, good bank account management, higher credit scores, willing to supply things like additional financials, then that might open up the door for them for a credit line as well. And the other thing is that revenue lending and merchant cash advances, what's the difference? Well, revenue lending, basically, the lenders are looking at all the revenue in the bank account. They're looking at all deposits. Merchant cash advances, they're only looking at credit card deposits from Visa and MasterCard. So that's a big difference for companies that do a lot of cash transactions versus credit card. Also, merchant cash advances sometimes require that they switch their merchant cash, their merchant account. We're not fond of that, and so we don't do that. And for the record, it's not required. We had a revenue lending deal that once we did the deal, they said, you got to switch to our merchant account. And we said, absolutely not. Take your money back. The loyalty that we have to our current merchant account is worth more than your money. Take your money back. And they said, nope, no issues. So again, this is why we typically do revenue lending. We don't have to switch merchant accounts. We get the bigger loan amounts because we're based on all revenue, not some. Revenue loans look at all deposits, as I mentioned. Okay, additional details. There are industry restrictions. Okay, loans are based what industries? There's too many to mention. There's over 100 industries that are considered to be high risk, including our own, which is financial services, accountants, mortgage brokers, credit repair, business credit. Any of us are considered to be high risk because we're in the financial services sector. Loans are based on bank accounts, not total business revenues. If operating more than one business account, they're only going to look at one business account and do about 12% of the annual revenue per that one account. There's no prepayment penalty, so they can pay it off early and not pay the interest. First and second loan positions, as we talked about. Approval pretty quick, usually same day approval. And then if we can sit it in with 6 months bank statements, can fund it as little as 72 hours. We have done these in one day, 24 hours, multiple deals, but I try to set reasonable expectations here. Anybody that has ownership of 20% or more has to have their credit pulled. Very common with almost every kind of loan that we're going to talk about today. Rarely does anybody under 20% not need a credit pull unless there's no credit pull for that kind of funding. Okay, so SBA, okay. So a lot of funding. we're starting to fund more SBA loans. We've never done this a lot in the past. We didn't have a lot of people that qualified, but we're starting to see more. 2 years of business and personal financial, business tax returns for 2 years. They got to have a 620 FICO. Really, that's what SBA says. What we found is they really need very clean credit, no derogatory items. SBA even puts on their website that anybody needs to clear up blemishes before they even apply. So, 620 they put out there, I think, is bogus. You're really going to need somebody with 700 type credit profile to get approved. Positive financials, what are they looking for? With all these lenders that want tax returns and bank statements, they're looking for revenues increasing over time, right? They don't want to see that you had a big drop off where you didn't have a bunch of revenues or your revenue dropped for a certain period of time. They want to see your profits are increasing. Okay, that's what they're looking for, is growth, period, growth. Growth means the money going into the bank account is going higher month to month to month. Growth means your tax returns show higher revenues and higher profits year after year. So lenders want to see use of funds make sense. Sometimes they don't care with other loans, but with SBA, they do care. They need to make sure that the money you're going to take is going to be used for a certain purpose that makes sense to grow the actual business. Now, cap lines are SBA's umbrella program that basically describes the credit lines they have. Like loans are up to $5 million, okay, and the exact same underwriting criteria. Now, they have a few different seasonal lines. They have 5 of them, actually. I shouldn't say a few. Seasonal line, which basically just has to do with advances against anticipated inventory and account receivables. What it's doing is it's saying, look, we know you're slow right now this time of the year. We know you'll get busy. We're basically going to give you a credit line advanced against future receivables, or receivables. So what they're doing there is helping people get through slower parts of the season for companies like, ski shops or ski slopes that are only open or doing business during certain times of the season. Contract line finances direct labor and material costs associated with performing assignable contracts. Loans revolving are available. So with all of these, SBA will give a loan or a credit line, and a contract line is just what it sounds like. It's for contractors. It's for contractors to be able to get financing while they're doing the work before they get paid. So let me give you an example. If I'm a plumber and I work for US Homes, which is a big home builder down here, well, then I'm going to do the work and wait to get paid. Well, you know what? Doing the work and paying for the money to do all the stuff I need to do, the labor, the cost to get out there, the materials, I want to get paid back. So contractor lines let them finance basically what they're doing while they're waiting to actually get paid. A builder's line is also designed for general contractors or builders, okay? Used very much the same as what a contractor line is for building projects to be able to fund the labor for those projects. A standard asset-based line is for businesses unable to meet credit standards associated with long-term credit. So basically what they're doing is they're issuing credit and they need money in the short term to kind of carry their business. Now, this is exactly the same as a small asset-based line. It's just a lower amount of money. So basically all these have specific purposes. You can see that they like contractors. They like people that have really a direct need for the money. I need the money to get me through this time. So then if I get through this time, I can make even more money. So a little bit on SBA loans. Now, term loans. So term loans are kind of like SBA loans. I mean, SBA loans can go 20 or 30 years in some cases if the loan amounts are higher. And by the way, you can get into high risk industries with SBA. What they're looking for, again, is cash flow credit collateral. Do you have good bank statements? Do you have good tax returns? Are you increasing revenues? Are you showing profits? Look, one of the biggest pieces of advice you need to give your customers is they need to show profits on their tax returns, even if it's a little bit. I can tell you that the difference between somebody that shows a loss and somebody that shows a profit of $1,000 is a huge difference in our world. Okay, the people that show a profit of $1,000 can get term loans. They can get lines of credit. It opens up the door for them to get better financing. The person that showed $1,000 less in profit, right, a loss, basically, those people, they can't get term loans in a lot of cases. They can't get lines of credit. Anybody that looks at tax returns is not interested because they're showing that their business is not making money. So, anybody that's accountant says, hey, write everything off. You don't want to pay taxes. The problem is that when it goes to getting outside investors, when it goes to getting lenders and alternative lenders to give you money, that's not what they want to see. So term loans is kind of an in-between from SBA. The credit doesn't need to be as good, The cash flow bank statements don't need to be as good. You don't need balance sheets and profit loss statements and resumes and all the collateral and all these things you need for SBA loans. You still get the benefit of lower rates and longer terms. But again, you're typically not going to have to go through all the things you have to go through with SBA. So again, 625 minimum, better credit's what they're looking for. 1 year in business, because they're going to typically want a year's worth of tax returns. 10,000 monthly revenue. Tax returns that show a profit are preferred. Basically, good credit and financials. So what happens is term loans, we get 2 of the C's, credit and cash flow. So instead of just what we talked about before, merchant advances and revenue lending, where they could just get it based on cash flow, these require both cash flow and credit. So if you have somebody that has better of both of those, then they have a good chance of getting approved, but the cash flow needs to be verifiable per tax return, some kind of profit. If they don't have some kind of profit, then they eliminate their ability to get a lot of this similar type of financing. Okay, so some options are available without tax returns, but most of them are going to want them. Loans are up to 30 years, typically about 3 to 5. Loan amounts in the millions. They can get up to 20, 30 years term if the loan is in the millions. 8 to 15% rates are typical. And by the way, okay, these are term loans. Everybody wants longer terms, lower rates, right? Well, I can tell you right now that we have, as a company, done, and we've seen clients get the exact same terms with revenue lending. 3 years, 8 to 15%. So again, if you have a lower risk borrower, revenue lending can be a faster, easier solution without tax returns, without a lot of those things, than even term loans. But it all depends on the risk of the actual borrower. So we've got some new sources that are lending from 500 to 15 million. These are high dollar sources. And what they do is they work with a lot of the top private investors around the country. They've pooled them together. They qualify for a bunch of different investors. Now, they're typically looking at the credit and cash flow, as a lot of these term loans are that we talked about. Bank account management, you got to manage your bank account on time, tax returns, some kind of profit. So a lot of these are just like anything else. They call this based on the business merits, right? So what they're doing is they're looking at basically the strengths of the business. What is the credit of the business? What is the cash flow? What is the bank account management? Is the tax return show profit? So these are just similar, but a lot more investors. These are available through private investors instead of alternative lenders, and you can get approved up to about 15 million bucks. So let's talk about credit lines. So AR credit line, account receivables are needed from approval. This is a collateral-based program. Lender plugs into your accounting software to review your AR. This is all the newest kind of artificial intelligence lending that exists, and we're seeing more and more of these sources come up. So account receivables are basically people that owe you money. Let me give you an example. If you're a partner of ours and you paid us through installments instead of one payment, then that's account receivables. We could borrow against those account receivables to get funding if we want to. That's what account receivables are. So what happens is the lender plugs into your accounting software. In our world, we use Xero. A lot of people use QuickBooks and other ones. So we plug it right into the accounting software. It reads the AR from the accounting software and issues an immediate approval. Rates are super low, 0.5 to 0.7 per week outstanding. What's that mean? The longer you have the money outstanding, it's a credit line, right? The longer you wait to pay it back, the more you pay. For example, if we borrow money on a credit line and we wait the max term of 6 months, we are going to spend about 4.875%, about 5% interest. That's good. One of my buddies came to me. We got him a credit line. He owned a credit repair company. He wanted a revenue lending loan. We put him in a credit line because we felt the rate was a lot better, which it was. He only needed the money for a couple of weeks. He paid it back. He only ended up paying like 1 or 2% interest. Okay. So less than 5% if you keep it for the max term. Basically, it's the equivalent of about $50 is what you're paying for every $1,000 borrowed. Payback terms about 12 to 24 weeks on these, so about 3 to 6 months. We've got some that will go a year on the same kind of program. No prepayment penalties on this at all. No consumer or commercial credit pulls here at all. Now, we've got some sources that never used to do any kind of credit pull at all. And now they're starting to do credit pulls if the customer wants higher amounts of money. So they'll give the customer the choice in that scenario. You can't have a BK in the last 2 years, and it's 48-hour funding. The funding is really quick, the fastest you'll ever find. Credit lines used to take 3-6 months to get done. Now they're getting done quick because this artificial intelligence is not requiring documentation. You don't have to supply an aged list of account receivables or these type of things anymore. Now that they're plugging right into the accounting software, the banking software to underwrite, which makes it so super fast. Typical lines are under $10,000, and then if somebody supplies tax returns, they can get up as high as $100,000. That's what we did. We got approved for 6. We gave them our tax returns. They gave us 30. We used the line. We went back 6 months later. They immediately jumped us from 30 to 100. We still have that credit line. We don't carry any revolving debt. We pay off everything at the end of every month, but it's nice to know that that's available to us in case that we want to tap into it. So this is one of my favorites because there's no credit pull in a lot of cases to get approved. High risk industries are accepted. Now, don't forget, this is about you and what you could do for your customers so you have some kind of background, but this is also for you. I mean, if any of this applies to you, reach out to your advising team, your finance team, your support team, and they can get you the finance officer that can introduce this for you as potential funding as well. Revenue-based credit line, we already talked about this, okay? Approvals based on revenue from bank account, lender plugs. Oh, actually, this is a new one. The lender plugs into your bank account for review. They're looking for the same thing that we talked about before, responsible bank account management. Again, typical lines are under 10 grand. It's the same program I just showed you, but instead of account receivables, this one's based on revenue. They plug right into your bank account. If you manage your bank account responsibly, they'll give you a credit line with very low interest. In a lot of cases, they never even pull your credit for the smaller amounts. And if you have tax returns that show you're making more, they'll typically approve you for higher amounts. And again, everything else is exactly what we talked about. No credit pull, 12 to 24 week funding, 0.5% to 0.7% rate. Fantastic program. So if you have a credit line or if you have revenue or account receivables, then this is a great program that could work for you or your customers on top of other revenue and account receivable financing we may offer them as well. Revenue-based credit line program number 2, okay? So this one's very similar, about a 0.3 to 1.5% rate per week outstanding, but this one goes to 12 months. Why does that matter? Because longer terms mean lower payments. So it's so funny. Everybody asks about rate, but with revenue lending, they're typically given options. And the options the lender gives them is to pay a higher rate and get a longer term, or pay a lower rate and a shorter term. 9 out of 10 times, everybody chooses to pay a higher rate with a longer term. Why? Because term matters more to payment than rate does. So the longer term we can get somebody, the lower their payments are going to be. So what's nice about this program is it goes over 12-month payback versus 6 months like we just talked about. Weekly, monthly payments are available, no prepayment penalty, 72-hour funding. High-risk industries are accepted with this program. So this is a pretty good program on top of what we just showed, but this has a 620 FICO score requirement. The other one I just showed before doesn't have any credit requirements. And you need 10,000 in monthly deposits versus 20,000 in monthly deposits versus 10. So on this program, rates can be a little better. Loan amounts are higher. Somebody can get up to 150 grand instead of 100, but they need to have more deposits and some kind of average credit to be able to get approved. 6 months in business, and then they really can't have a lot of non-sufficient funds to be able to get approved. So along the line of credit-based financing and credit lines, these are what we call the unsecured business financing program, an oldie but a goodie. And unsecured business financing, this is one of the most common programs we fund because a lot of our partners are dealing with startups. A large percentage of the people you're putting in are fairly new in business, and this is a great program, the best I've ever seen when it comes to startups. So if they have mid 600 score, 650, they can get standard credit cards. Standard means they report to the personal credit reporting agencies. 680 means they get business credit cards, which report to the business credit reporting agencies. Let's take a look at both of these. Approval amounts range from 10 to 150 grand. They're typically approved for up to 5 times the amount of their highest credit limit account that they have now. So if the highest credit limit account they have now is 10 grand, on their credit report, the highest credit card limit, and that's on a major credit card, a Visa card, a MasterCard, they'll typically get 5 times that amount, which is like $50,000. And again, they're going to need low inquiries and utilization under about 60% on this program. Business cards, it's a little lower, and they're going to want low inquiries, probably less than 6 inquiries in the last 6 months. They These ones, personal cards, report to the consumer credit reporting agencies. They basically get up to 5 credit cards, creates competition between those credit issuers and makes it easier to get their limits increased over time. 0% rates for 6 to 18 months, and normal credit card rates after that. So 9 to 12% fee the lender will charge is typically 9.99. They'll need good personal credit, 650 score to get approved. As we talked about, less than 50% utilization, sometimes under 60 even works. Less than 8 inquiries. I said 6, but actually we can do up to 8, it looks like. One of the best ways to get the highest amount of money, even if you're a newer or startup business. This also pays you pretty well, about 2 to 4 points. Now, this is exactly the same program. The only difference is, and this is the preferred program, they try to put people in this program first. And this program reports to the business credit reporting agency. So I love this. So they're getting 5 cards, 5 to 8 cards based on their highest limit account. The cards report to the business credit reporting agency, so they build their business credit as well as getting 0% rates for 6 to 18 months. So if somebody wants the most amount of money with this program, they're better to go with personal and business cards. And that's the way the approvals come. The approvals will come, and here's just what you get with business cards. Here's what you'll get with combined with business and personal, or what they call standard cards. Somebody's going to get more money if they don't mind some of their cards reporting on the personal reports, if they want the most money. If they want the amount of money, they don't care to get the max, and they don't really want personal reporting, then these business cards alone make sense. Same fee, 680 FICO for approval, utilization under 30%, less than 4 inquiries in the last 6 months. I've even seen 5 or 6 may work. One of the best ways to get money, even as a startup business. Now, here's some new things you need to know about that are newer in the last, let's say, 6 to 9 months. You can get cash out. So they can get the cash out of these cards without paying the 20% interest rates. That's what makes this program ridiculously cool. 1, they're building business credit. 2, they're getting like $50,000 to $150,000 even as a startup, which is more than I've ever seen with any program, even angel investors with startups. Now they can get the cash out of the cards. They can take all it out in cash if they wanted to, and they're only paying 0% rate for 6 to 18 months. This is the only program you'll find where people can get 0% rates and take the cash out. So you can imagine a startup getting $75,000 in money in cash at 0% for 18 months. It's insane. This combines like the best of every program into one. Rapid rescore. So we've got multiple sources now that will rapid rescore them. So if their score is low, let's say it's 660, not 680, and they've got a balance on the credit card, they could pay the balance down, prove that they paid the balance down with a statement from their credit issuer or letter, and then we could have it rapid rescored in a day, update their score, and lend to them. So it expedites the time they can get money even if they don't qualify because of a factor like their scores aren't high enough. They can also get loans, this is sick, loans to pay down the balances on the credit card. So let's say their utilization's at 40% and needs to be below 30, and they need $2,000 to pay down the credit card to be able to qualify. Well, the actual finance source on this will issue them a loan to pay down the balance on the credit cards, then we'll rapid rescore them, then turn around and actually get them the credit line. So it's a really, really, really cool way. So what we're saying here is that, hey, look, even if somebody scores a little bit low, then they can do some things that will rapid rescore them quick. Or maybe they need to pay down balances and need the money, then they'll lend them the money to be able to do so. They're also doing soft pulls through our 2 main sources now. So soft pulls are where there's no hard inquiry on the credit report they use to qualify them. But when they actually go to get the credit lines for them, they will be hard pulls. But at least the inquiry to see who qualifies is a soft pull, which is nice. Credit line and term loan, this is brand new. This combines the term loan and the program I just showed you with unsecured business financing. They need about a 660 FICO for approval, 2 to 3 year loan term, 6 to 11% rates, and they're going to need good banks, and the approval is going to be based typically on the revenue. So the program I just showed you is called UBF, for unsecured business financing. We found that this brand new program, I mean, we've been working with this for less than 90 days, gets our clients on average 1.5 to 2 times the amount of unsecured business financing. So if we can get somebody $50,000 in unsecured business financing, we found that when we do both combined through the same source, we can get them 100. We can get them 1.5 to 2 times, double the amount of money with this. And what happens is we go through one finance source to maximize the inquiries, and the one finance source offers them both a term loan and a line of credit at exactly the same time. Guys, this is really hot off the press. I mean, this is something that we just started doing a few months ago in testing, and we're doing a lot more of these than we ever have before. So again, somebody's got to have the revenue. It won't work as a startup like the unsecured business financing program I just showed you will. But this is a fantastic way with somebody that is in business, has some revenues, and also has the credit to be able to qualify, to be able to get more financing. Collateral-based financing. So any type of viable business collateral works. Some type of personal collateral works. Some type doesn't, like mortgages. Real estate will not work as collateral for most kind of collateral-based financing unless it's like an SBA loan. If it's an SBA loan, you can use your house as collateral because they basically make you. But every other type of collateral-based financing isn't going to use your home. It's only going to use some kind of personal collateral. We'll talk about that. Acceptable business collateral, account receivables, purchase orders, book of business, equipment, inventory, commercial real estate, commercial vehicles. These are the most common ones. We see some rare ones that other people come in with other kind of collateral that we get done, but these are the most common ones we see. Personal collateral, stocks, bonds, 401ks, IRAs, residential real estate if they're flipping it, flipping homes. So that's mainly the kind of collateral you're going to find with collateral-based funding. House flipper financing. Get 100% of the financing you need to purchase and rehabilitate residential properties. We find that private or people that are investing in real estate are one of our top 5 industries we service, so this helps a lot of your people. Okay, lenders will loan up to 65% of after repair value. What do these two numbers mean? What it means is this: if you buy the home right, you can get all the money you need to rehab and fix it and to buy it. You just can't exceed 65% of after repair value, at 65% of what the property is going to be worth after you fixed it up. So you'd have to buy a property right to get 100% of the money you need to do this. But as long as you're buying the property right, which is the name of the game if you're flipping homes, then you can get 100% of the money you need to flip the home. So you can usually get about a 6-month term, short-term financing. It's a fix and flip. You shouldn't be trying to fix a house up more than 6 months if you're intending on flipping it. Rates range from 8% up. Okay, and you'll need to have about a 660 FICO, flipping experience with a few properties under your belt, and you got to have cash on hand to put into an escrow account. You know, at one point, we even stopped promoting that we had this, and here's why. Almost nobody qualified. The reality is a lot of these investors that are coming into us are dreamers. They've never done a project before. They don't have any cash on hand, and their credit's trashed. But if they've got somebody that's got average credit, some money in the bank, and some flipping experience, then they may qualify. Why the money in the bank? Well, they're going to want to put some in an escrow account. They're going to want them to have some money, some kind of skin in the game. How much? Depends on the project. But before you even worry about that, worry about finding somebody with a 660 FICO score and flipping experience, because a lot of the flippers you're talking to do not have experience out there. Okay, uses real property as collateral for the debt. Okay, so basically it's short-term residential purpose and renovation projects. And again, most banks just don't do this kind of financing. And again, what happens with this is it's kind of like a construction loan. If you've ever had a construction loan, the way that homes are built with construction loans, it's done on draws. So a lender lends money to the builder for phase 1. Builder proves they finished phase 1. Lender releases money for phase 2, et cetera, et cetera. Same thing here. Lender releases the money in draws to pay contractors for work done until all draws have been released, which means the project is done. So that's how this program actually works. Account receivable financing. Account receivable is what you need to know. Let your payments pay you. Let your customers pay you on terms, especially if your customers are businesses or the government, because this is the most valuable asset a business has. That is maybe not a factual statement, I don't know, but I'm telling you that because SBA looks at account receivables as the #1 asset that they see as lendable. And anybody I've talked to that flips businesses, that buys and sells businesses, says the same thing, that account receivables is the most valuable asset a business has. Having it makes you worth more money because it opens up options like SBA loans. So account receivables are, again, people owe you money, they pay you over time. Okay, you can get loan amounts of 5,000 to 20 million. Up to 90% of receivables can be advanced within 24 hours. This is new. It used to be 80%. Now we've got lenders that'll go as much as 90% of the receivables can be advanced within 24 hours. What does that mean? Let me give you an example. Let's say somebody is going to pay you 10 grand and they're going to pay you over 5 months. Well, what happens is in that case, let's say they're going to pay you over 90 days. In that case, they would give you 90% of that 50 grand, right? So they would basically give you 45 of the 50,000 in the next day. Boom, you don't have to wait for it. Then when that customer that owes you the money pays the invoice, pays all the bill, then they give you the rest, the other 5% minus their fee. So that's how it works. So if somebody's going to pay you 10 grand over 3 months, you have a choice. You could, one, wait the 3 months to get your 10 grand, or two, do this kind of financing and get most of that money, 9,000 of it advanced to you the next day. You got 9 grand the next day. You didn't have to wait. And then the other 1,000 is released once the invoice is paid. The other cool thing about this is the lender collects on the invoice. 1.25% to 3% discount. That's the rate you pay. Okay. 4% fees common the first time you get the loan. No credit score requirements to qualify. Receivables are used as collateral. And again, that's the same. Receivables must come from another business or the government. So somebody can't, as an individual, you can't use, if you're a credit repair company, it won't work, for example. Okay, consumers will not work. You have to have business customers or government as a customer to qualify. You got to be in business at least a year. Medical receivables can qualify, construction and conventional. Those are the most common. The most kind of account receivables that exist are for the medical industry, Medicare, Medicaid, health insurance, waiting to pay doctors. It's construction, where they're having to wait to pay contractors until the house is done and sold. But then they also have conventional receivables, which works for us. Okay, we have account receivables. We've talked to lenders about account receivable financing, and it's really fairly cheap too. But again, we just never had a need for that kind of money. Medical needs to be higher. Most of them don't care about the volume of receivables you have. With medical, they do. You need about 600 grand in medical receivables. And they can pay you recurring money. So once you do an account receivable deal, you get checks like forever. Because what happens is once somebody gets into account receivable financing, they typically don't want to get out. Like if you go to getting your money, 90% of your money the next day, like from Bob, like why would you ever want to wait now for Bob to pay you over 3 months? It just usually doesn't happen. So when people usually get into these kind of financing, they stay in, which means that you'll get recurring ongoing checks. Now they're not big, like we get $50, $60, $100 from different customers, but it's recurring money. So it's one of the only kind of financing that will give you that kind of recurring payout. Purchase order financing, $5,000 or higher purchase orders we can finance. Up to 95% of the purchase order can be advanced. 5% less the lender's fee is released once the actual invoice is paid. So purchase order financing is where you need to buy something to fulfill an order and you don't have or want to use your own money to buy the thing you need to fulfill the order. I always use exactly the same example. Don't know why. As a t-shirt embroidery company, you get a huge order for t-shirts. You don't want to go to your supplier and have to pay out of pocket for all those t-shirts, then embroider them and then wait to get paid. Instead, you can use purchase order financing. The lender pays the supplier for the shirts. You get the shirts, you embroider them, you turn around and sell them. So that's an example of how purchase order financing works. 1% to 4% rates, no credit score requirements. Letter of credit is issued to the actual supplier, and cannot be for unfurnished goods. You can't be for part of the process of actually completing for what's referred to as unpurchased goods, which is typically in the manufacturing segment. Applications, copy, and purchase orders, all that's needed to get approved. These pay you about 0.5% to 1%. We don't make a lot on that, nor do we do a lot of those kind of financing. Book of business, commissions from book of business service collateral for insurance agents only. 3-year, 10-year term loan, 4 to 9% rate plus prime. 520 FICO, so really no credit score requirements. They get about 120% of what's called the surrender value, or what they would sell those stocks back to an Allstate if they were to close their shop or close their doors, for example. No State Farm agents because they don't own their book of business. So this is the only kind of financing I've ever worked with in my entire life where the majority of people can qualify for more money than they ever end up taking. It's weird. Like I said, almost everybody I've ever met in business and seen as customers, they want more than they can get. With this one, they could get so much money typically that like the customer's like, whoa, dude, like I don't need 400 grand. I just need 40. So they usually get really quite a bit of money here, and they get it on longer term. So it's a great program if you're dealing with any kind of insurance agents. And by the way, book of business financing is often used to purchase agencies as well. So if you got somebody that comes to you and they're a customer and they say, hey, man, I own this insurance agency, you should tell them about book of business. Say, you could use your book of business to get financing with really good terms. Is that something you're interested in? And they may say, no, I'm good right now. Say, you could also use that kind of financing to buy another insurance agent. So if you see another agency you want, you need to let me know, because this kind of financing is often used to be able to use their book of business as collateral for you to basically finance the purchase of the insurance agency, which is pretty crazy. I've never heard of any kind of financing that is specifically designed for you to use the seller's assets as collateral to buy the business, but that's exactly how this is most commonly used. Equipment financing, startups can qualify 10,000 to 20 million, 12 to 48 month terms, rates of 5 to 55%. There we go again. I love wide interest rate ranges, because what it means to me is if I'm low risk, I'm going to get good terms. And if I'm high risk, I'm still going to get approved, and you're not going to like beat me up and tell me to go away. So I like these rate ranges. It means that it works for low and high risk individuals. 580 or FICO or higher, 620, 650 is preferred. Down payment can be as little as first and last month's payment. Okay. And equipment leasing is another option as well. With equipment leasing, they've got to be in business 1 year. It won't work for startups. Same thing, 10 to 20 million, 12 to 48, rates are the same. Everything's the same, just they need to be in business 1 year or more. So here's what you should know about equipment leasing and financing. First of all, you need to always ask your customer how much money they want and what they need the money for. Because what I find is a lot of people need money for stuff that they shouldn't be getting a loan for. Like they're coming in, they go, I need a credit line. And why do you want a credit line? Because I got to buy this piece of equipment for my business. No, you need equipment financing to purchase the business, the finance to the equipment, and then we'll get you a credit line just to have whenever you need it. So I have a friend of mine that came to me, and this was the scenario: is she came in, they were opening a new doctor's practice, a new I'm not going to say doctor's office. I'm going to say it's a doctor's practice because of what they did. They help doctors market and run their practices, and they needed equipment as well, and they needed to pay payroll. So what we did with them was we got unsecured business financing credit lines where they could take the cash and credit and use it to pay payroll. We got them equipment financing to be able to get the big piece of equipment they needed, and they used the unsecured business financing cards to pay the first and last month's payment on the equipment financing. That is the brilliant strategies that our finance team can do, because we work with these completely different, completely unique kind of funding programs. We came in, we said, what do you want to do? I need money available while we're getting this venture off the ground. We need to pay payroll. We have some other things we need to pay. And then we also need to buy this big piece of equipment. We'll get you equipment financing. We'll use the credit line to pay the first and last month's payment of equipment financing. And then you still can pay payroll and have all this available money for you. And it works really well for them to be able to get that business off the ground. Equipment sale leaseback is where somebody has equipment they own already, and now they're going to borrow against it. They could typically get about 50% of the equipment value. They can get it as a startup. So I can go to grandpa that has a backhoe, and I could use his backhoe to borrow against to get money to start my business, for example. I use those examples because when I'm trying to help people get money, I tell them, look, there's a lot of ways you have to be creative. If you're going to go, 75% of business owners get money from family and friends. So if you're going to go to your family or friend and ask for money, now you don't just have to ask for cash. Now you can ask for things like this, for equipment. Or as you'll learn about soon, stocks, bonds, 401ks. If they have stocks, bonds, IRAs, 401ks, equipment, assets they own, you can use those as collateral to get the money you need without taking physical cash from a family member or friend. So some other options as well. 10,000 to 20 million, 12 to 48 month terms. Everything else is exactly the same as we talked about. It's just people borrowing against equipment that they already own. Inventory financing. This is where you are basically borrowing against inventory you already have. You need to have about $250,000 to $500,000 is the loan amount you're going to need. So you're going to need about double that to be able to get approved. You're going to need at least $500,000 in inventory to get approved for this. You get a line of credit, 2 to 5% rates, no credit score requirements. You got to have $500,000 in inventory, and you can get a line of credit for about half of that money. So this is what happens in these scenarios is where you have companies with tons of inventory and they're cash poor. They can basically use their inventory as collateral to get financing. One of my favorite business shows is The Profit, as it is with many of you, we found out per surveys. And we see these things in that world quite a bit, where they have all this inventory and then they're trying to get an investor to come in to invest cash in the business because they don't have money. Well, this is a great way to get a line of credit against that inventory. They've got to have a good inventory management system. If you've ever watched The Profit, you've seen what happens when they don't. It's usually they only have a fraction of the inventory they thought they had, and it's pretty easy to get approved with that as well. Securities-based financing. These are stocks and bonds. Somebody can get as much as 90% of the stocks and bonds value they have. 5-year loan or credit line. Prime plus 2% is what they pay. No FICO requirements. Almost all stocks and securities we've seen are accepted. Pretty easy to get approved if somebody has stocks and bonds, whether it be you or somebody you know, your customer or somebody they know. Commercial real estate financing, $75,000 to $20 million loan amounts, 55 to 65% loan to value. We also deal with SBA 504 loans here as well. 2 years financials, tax returns, P&L, debt schedule. What they're primarily looking for is they want to make sure that the business is generating enough cash flow to pay for the property, or preferably that the property is generating enough cash flow to pay for itself if it has tenants. Business must have cash flow to make payments, 650 FICO. You got a PG, 4 to 5% interest. And again, loan amounts are kind of all over the board, purchase or refinance. 401k or IRA, very similar to stocks and bonds, but somebody can get as much as 100% of what's in their 401k. They can get a 5-year loan or credit line, prime percent plus 2, no FICO requirements. The lender will charge a fee of about $2,000, and they roll that right into the deal. Now, we have a funding program cheat sheet in your back office. I think it's under the funding resources section of your back office that gives you a summary of a lot of this data as well, in the case that I may be going a little too fast. And most of the stuff pays you 0.5% to 2% because we just don't make a lot on that kind of financing, nor will we do a lot of it. You can get money to purchase commercial vehicles, can be buses, trucks, emergency vehicles, others. This is fairly new in the last year we rolled this out. Can borrow against free and clear vehicles as well. So again, if somebody has vehicles as collateral, we can do a lot with those to help them get buses and ambulances and all kinds of crazy things we've helped people do, and they can also borrow against those. Of course, don't forget business credit. It's a catch-all. If somebody doesn't have collateral, cash flow, or good credit, okay, they can get immediate vendor credit, the store credit, fleet credit, Visa cards, the MasterCards, without a personal guarantee, without a personal credit check, without the financials. They can get it as a startup. They were building their business credit as well as getting financing. The utilization does not affect their personal scores. No personal credit inquiries on their credit report. And then, of course, business credit oftentimes determines the rates and terms that people pay. So you need to be upfront and talk to your customers about this. You know, the way that this works is that, look, if they want to get the best rates and terms on the financing, then what they need to do and understand is that business credit's going to determine the rates and terms that they're often going to pay on the financing they get. So they can't ignore business credit. Just because you can get a loan today doesn't mean that you should not build business credit, because you're going to continue to pay shorter terms and longer or higher rates until you build your business credit, right? So it's the same as going to AmScot. Just because I can go to AmScot and get a payday advance at a super high rate doesn't mean that I don't want to fix my personal credit so I can go to my bank and get a better rate, right? Just because you can get access to money doesn't mean that you don't want to fix the underlying issue that's preventing you from getting access to even more money. Okay, and that is a perfect example. Just because you can go to AmScot and get a payday advance doesn't mean that you want to ignore the issues that are causing you to get a payday advance versus getting a signature loan at your bank. So they still want to build their business credit because it determines the rates and terms they'll pay if they'll get approved, these other types of things as well. So business credit becomes very, very, very important for them as well. So that being said, again, what it really comes down to is, and I'm going to stop this and kind of go back to the beginning. What it really comes down to is it really comes down to this 3 C's of lending formula. And I'll kind of talk to you about what we do. We just call this a graduation, basically. So what happens is originally somebody comes in, they typically have none of these or one of these. If they have none, we put them in business credit. If they have one, we get them the revenue lending or the merchant cash advance for cash flow. We get them the credit lines, the unsecured business financing that we talked about with credit, or we get them one of those collateral-based programs, 401k, stocks, bonds, equipment, inventory, purchase orders, real estate, commercial real estate. We get them one of those kind of financing, or sometimes multiple. Then as they get better, as they get second, which usually they get cash flow and credit combined first, then we get them term loans. Then we get them lines of credit. Then we get them more of these alternative SBA loans with longer terms and lower rates. And then we graduate them to the next level, which is the grand finale, which is they have cash flow credit and collateral, which is SBA. The reason I tell you this is because this is something unique you have access to that nobody else does. Nobody that's not a partner. Because we're the only source that works with every legitimate kind of funding that's out there, we have this strategy of, hey, look, even if you can't get a loan, we can help you get business credit. Even if you can get a loan, we'll help you fix the underlying issues to get you to the next tier of loan, which is being able to have 2 of the 3 C's. And then we help work with you on a long-term strategy to be able to get up to the SBA loans, to graduate to the grand finale of you being able to get really long terms and low rates. And every step of the way, we can get them multiple different type of financing to get them more. We've got clients we've got over $1 million for, $1.5 million plus, and they combined every single one of these kind of financing, credit, cash flow, and collateral to be able to get there. So some of the benefits that you can talk about with your customers, look, we can help you no matter what your situation is. If you can't get a loan, we can still help you get business credit. We deal with every legitimate type of loan, and we now have over 1,000 lenders. So every type of legitimate loan with over 1,000 lenders means we can get you more money because we have more different options to get you the money. And as we get you the money, we're not done. What we want to do then is we develop a blueprint, a finance blueprint, to get you even more money, to get you to the next tier, which means longer terms and lower rates. And we continue this graduation process until you're to the very end of SBA, where you get the longest terms and lower rates. And we do this a lot through education, educating them the value of collateral, helping them understand the value of having assets and what that means for them to graduate, helping them understand that they need to show profits on those tax returns. That's what opens up lines of credit. That's what opens up term loans. So helping them understand these things to graduate from level to level is really our goal here, is to get them financing and continue to get them financing. Also, don't forget, if you're executive, you basically get paid on about half of everything we make on almost every program. So that means that when we close the deal and make 4 points, you get 2 of the 4 points, and you're just referring the customer in. We're doing everything else to close the deal. So again, you can get paid on funding that you're getting for your customers, even ones that are coming through the business credit builder. The other cool thing about this is you can also submit customers directly for funding without them ever needing to buy anything first. So through the back office and the sections in your back office, you're able to come in and actually get financing for your customers as well. And again, if you're part of executive, I'm not here trying to sell executive. I'm just trying to let you know that, again, if you are executive, you have the ability to make money on these funding programs as well as add them. So when you come to add clients, you can add clients, for example, to just get funding where they never need to even buy anything first. You don't need credits. You don't need anything. You can come in and then track your funding commissions, which they don't pay me funding commissions. I think they should, but apparently I don't have any, as you can see here. And then you can also track your clients in your client dashboard, seeing every stage that they're in. And you also have access to a lot of other resources here in Resource Library. You have access to all the finance resources, which gives you videos to market financing and a bunch of other things. Now, even if you're not executive, you still have the finance program cheat sheet. You still have the stuff that you need to get paid, and a funding process outlines and commissions. But even what's nice about executives, it even even gives you access to all different kinds of other financing that you have that's specific, like videos and marketing flyers and stuff, which has to do with specific programs. So just letting you know, these are some of the additional benefits with the executive program as well, things to consider. And we report all of your payments to the business credit reporting agency, to CreditSafe. So again, if you are executive, you're getting the benefit of that, building your business credit as well. So I'm going to open this up to answer any questions that everybody may have. Can we go more detail about the vehicle financing? Sure. Chaz, how do you become executive? You can go to creditsuite.com/executive, and then you'll probably get an error if you try to do some things. Executive is pretty simple. It's just $99 a month, and you cancel it at any time. And if you go to creditsuite.com/executive, it will just tell you all of the things that you actually can do. And again, I'm not going to go on and on about this because I don't want to try to seem like I'm selling something. But if you go in here, what happens with executive resources is every time, a lot of you know, every single week I do webinars. And I take the PowerPoint, the video, and all of those are available for our executive resources as soon as they're done. As a matter of fact, you get access to the video on Shelf Corporations before we even do the live session on Shelf Corporations where we're using that PowerPoint. You get access to the PowerPoint we're using to film the Shelf Corporations video before we even do. So I'm not saying you need to try to beat me to the punch, but you could. You could easily do our own presentations before we even do, because the PowerPoints and videos are released before we even go live. And the reason for that is because we have these scheduled to January 2019. So a lot of those resources, but again, to answer your question, executive, creditsuite.com/executive is where you'll go. Commercial vehicle financing. Let me know what questions you may have. Ultimately, what we're doing is two things. We're getting them the financing to purchase commercial vehicles. And again, I gave you some examples of buses, government vehicles, vans, etc. Even ambulances are some we've done. And again, they can borrow against those as well. Interest rates are kind of all over the board there, about 6 to 15% that we've seen. And I can't even give you an idea of loan to value because it really does vary based on vehicles. But if you have a specific scenario to ask, then just reach out and talk to our support team, support@creditsuite.com. Engage with chat right here on your finance suite, and we will help answer any specific scenario questions that you may have, Chaz. The truth is, Chaz, I just don't have a bunch of details. You know, I have all the lending programs on details on the program, but it's so vague that I don't have much to tell you beyond what I've already told you. There wasn't much of value I could even give you from what I've seen. But if you have any other questions on a specific deal, we will look at that. I don't have any other questions. If you do have any other questions, please reach out to us and let us know. Support@creditsuite.com. Don't forget, we are reporting your payments now to CreditSafe. So anything you are getting, prepaid enrollments, done for you marketing, campaigns, any of those type of things, you easily can benefit from building your business credit. And I mention that because I always forget to, and I want you guys to know that you get that benefit. Any other questions that you have, let's go ahead and get them typed in. I want to make sure that those are answered. In addition to the executive program, you have some kind of done for you. I don't have a done for you for $5,000, no. Alan, and I don't think you, Alan Harrison, you're not, wrong Alan, sorry, I thought you were another Alan that's in here quite a bit. So if you go to done for you marketing, creditsuite.com/done for you marketing. First of all, if you're Ultimate already gets done for you. It's already part of our Ultimate program. If you came in as VIP, you can get done for you program, and you could do it for $11.95 or 2 payments of $6.59. If you go to creditsuite.com/done for you marketing, all put together, no dashes, you'll see what we do. We basically just take all the resources that are in your back office and we just set them up for you. It's basically what we do. We just basically come in, we set up your articles and put your bio info. We set up all your ebooks and put all your branding in. We come in and set up all your flyers. We put all your branding on all your PowerPoints and your press releases. We get the videos all up on your social channels and get all those listed the right way. And then we also even engage and set up all of your first initial posts on social media. So what we found is it just takes our clients about 30 hours to set up all their marketing for them. And with Done For You Marketing, we're just doing all that for you. It just saves you those 30 hours worth of time if you just want something all set up and ready to go. But again, if you're Ultimate, you already get this. If you're not, that's what that is. So hopefully that answers the question. Is the replay of the weekly webinar for last week going to be posted? No, it will not, Ralph. And here's why. I didn't hit the record button. Somehow, some way, it's not like I've been doing this now for 6 years. Every single week, but for some reason this time I forgot to hit the button, and here's why. Go to webinar, change the feature where I don't have to hit the record button to record anymore. But since this one was set up before that feature rolled out, I have to hit start record manually every single time. And once in a while, you'll see I forget. Last week, I forgot. I don't have it. So that webinar will never be released. That's one lesson to learn, is come to the live sessions. You always get the webinars in case I forget to hit record, but that is what happened there. So no, that will not be released as a playback. And Alan says Ultimate is what I meant. This extra program. Oh yeah. Well, if you're already here, Alan, so you're VIP, you wouldn't need to pay $5,000. If you ever wanted to upgrade to Ultimate, just reach out to whatever team member you talk to who helped you on board, who helped bring you in as a customer or as a partner, and they could talk to you about upgrading. You could just upgrade from VIP to Ultimate at any time. You could basically raise your payments like $100 or $200 a month, whatever works for you, and whatever they tell you. I think it's $200 more for Ultimate, but they'll work with you on that. So if you just want to upgrade from where you are to Ultimate, you could do that. You don't need to pay $5,000 on top of what you already paid. It's a little bit more, but they'll talk to you about that. So just reach out to whoever it was that you talked to that helped you come in. I don't seem to have any other questions. Thank you. No problem, Alan. Great. Thank you. Great question. All right, I'm going to wrap this up, everybody. If you guys have any other questions, we're not going away. Just reach out to us and let us know. Support@creditsuite.com. Guys, look, there are some ridiculously sick things that you're going to be seeing the rest of this year from us. I mean, we have, it's been 2 years, maybe 3, before we've rolled out as much as we're about to roll out in a one set time period. Some of the sickest things that we've ever done, we are about to roll out that I think you guys are going to love, including making it very easy for you guys to be able to have the whole deal closed for you. The prospecting, the sale, the presentation, the close. That's what I'm working on right now, is to get a program rolled out where all of that's done for you. Some other things where you're going to be able to benefit from our branding and all the work that we've done to build the Credit Suite brand, and you're going to be able to benefit from that. Some other things we're doing, and all kinds of really cool special rewards we're going to be rolling out to you guys too, with pins that you can earn with all different kinds of things, and you're going to be able to collect these pins. It's really some really cool things that we're doing there, and then rolling out some new additions here to products and services that you're going to be able to benefit from, including our own credit score, which determines the lendability of businesses. That's so sick. It plugs into LexisNexis data. It plugs in to the same places that the reporting agencies are getting their data from. So there's all kinds of things like this that'll be rolling out in the next probably 6 months or so. I'll keep you in the loop as they are rolling out. So I'm going to go ahead and wrap this up. If you have any questions, please let me know. Over the next week, I will be here next week. The next week, my marketing team takes over, and they're doing a really cool session for you guys as well. So if you have any other questions, please let us know. Support@creditsuite.com. Otherwise, I look forward to talking to you all and seeing you here on our weekly coaching webinar that happens every Tuesday at 3 o'clock Eastern. Bye, everybody. Have a great day.